Today I'm going to start off with a very simple question. If the housing market truly crashed in 2025, like so many news articles were talking about, so many videos that were posted, then why did prices not follow that story? If we look at, for example, Redfin's data, per their articles and their information is saying that we actually hit a historical high median price in June of 2025, which in the summertime homes typically always peak, but in comparison to the year prior to 2024, it was higher. So if prices came down after the summertime, then if we look at entire 2025 in comparison to 2024, the median price was still up slightly by just a few percentage points, but it was up. Also, if you tap into the National Association of Realtors data, the story is the same. Prices did not crash. So why didn't the median price crash? Well, one of the major reasons is that the market was not flooded with sellers, and it certainly wasn't flooded with buyers. In terms of unit sales, as I said, we had one of the worst years in recent history. But homeowners today are sitting on something incredibly invaluable, and that is very cheap mortgages. Many people are locked in below 4%, below 3% even. Folks today, buyers that are in the market or potential buyers, they're looking at 7% and they're thinking this is really expensive, right? When if you go back decades ago, having a mortgage interest rate of over 10% was quite normal. But what people are remembering and what they're thinking is the norm is what we've seen during the COVID years. But that was really induced by the government during a time when the market was slowing down. And so that was their way to jumpstart the market again. And so those people who grabbed a lower mortgage interest rate, good for them. Well, they're also the ones that are saying, why would I sell my house right now just to rebuy at 6% or 7%, which then means for them that their monthly cost could easily double. If I were them, I wouldn't do it. And that's exactly what a lot of sellers were thinking. I'm just not going to sell right now because I don't have to. Instead, they went to remodel it. Perhaps they were delaying the sale of their house to see what the mortgage interest rates would be in 2025 or 2026. And some of them actually even decided to just rent out their home or perhaps the second home instead of selling, waiting to see what happens in the future. Those behavioral changes also changed the entire housing cycle. And so if you compare it to 2008 during the housing recession, one of the worst we've ever had, a lot of sellers were forced to sell because of mortgage delinquencies. But if we look at 2025 and where the mortgage delinquencies are, especially in comparison to 2008, it's relatively low. And that's because sellers are not forced to sell. And so a lot of them are just staying put until further notice, I suppose, until they see what happens in 2006. Now, you may have been seeing the headlines that typically always come out at the end of the year because real estate is very seasonal. And so prices would typically always increase right towards the summertime. So that's when prices go up because there's more sellers on the market, but also way more buyers that are now looking to purchase, and that drives up the price, right? Supply and demand. And then during the summertime, people on vacation, kids are going back to school right after summertime, and everything kind of slows down. So towards the end of the year, we always usually see the prices coming down. That's called seasonality, and I just wanted to make sure that you keep that in mind because moving into the spring season now, we should be able to see prices coming up yet again. But what's most important is to understand how it changes year over year. That is really a key teller whether the market is going up or it's going down. And that's what's going to make 2026 really interesting, is to follow the data, because we're in a world where policymakers want lower mortgage interest rates, but inflation, global bond markets don't always cooperate. Recently, you may have seen headlines about large-scale proposals to buy mortgage bonds to make borrowing cheaper and housing more affordable. And that kind of intervention can actually make the mortgage interest rate drop, especially in the short term. And that's essentially what happened just recently, where it actually dipped below 6%. And if we look at the data from Mortgage Bankers Association, that drove a lot of buyers back into the market. Mortgage applications were up by approximately 28%. When these rates briefly dropped into the high 5%, that is actually a great example of how lower mortgage interest rates will drive more buying demand. So we're going to have to keep an eye on the mortgage interest rates in 2026 to see which way it goes. If it goes down, we can expect there to be more demand for housing. But then when we look at what lenders, bond traders, and economists are currently saying is that what's happening on the mortgage interest rate side because of policies, interventions, is that it's more going to be short term, and their expectation for the mortgage interest rate is going to be right around it being at 6%, maybe hovering over 6%. As we all know, these are just predictions and they may not hold true unless we have another COVID situation, which I hope we'll never have again, or a situation where the government needs to step in and really jumpstart the economy again. We're probably not going to see 3 or 4% anytime soon. And this actually brings me to the most important point, and that is looking at national data is not useful anymore unless we understand local data. Right now, looking at just trends, we could essentially have dozens of local markets that are going to be behaving very differently. One example is to just look at the Northeast and the Midwest. Those are areas that have very little construction. And so when a home goes to the market, it won't have as much competition. And many of them will sell at list price or even over and much faster than if you're, say, in the Sunbelt area where there's so much new construction happening, and it always will come back down to supply and demand. There is just more demand up there for the supply in the market, and here in Florida, other Sunbelt areas is more competitive for sellers. And so if somebody asks, is the housing market up and down? The most precise answer is going to be, where are you looking at? What location? Because then I'm going to tell you if it's up and down. Let's actually compare data. Cape Coral, where the median price is actually down by -5%, and it's now hovering at about $370,000. This is based on Redfin's data, November 2025 versus November 2026. And now let's contrast that to Manhattan, where the median price for that same time period was actually up by 8%, came in at $1,300,000. Manhattan still has enough demand to command these higher prices, but the price points also illustrate how there's always going to be demand for Florida living, because the prices here are just so much more affordable for somebody that's coming from a luxury area such as Manhattan or California, San Francisco, some places in Canada. Now let's talk about something that's absolutely reshaping the housing market and will continue to reshape the housing market in 2026. That is insurance costs, which is increasing in Florida, but also really across the United States. When you're purchasing a home, even if you're a cash buyer, you're going to want to understand what the carrying cost of the home is. Insurance cost is really going to influence people right now in purchasing homes, not just in Florida. I mean, this goes for California, other places across the United States. But here's the good news, especially for Florida, the insurance market seems to finally start to stabilize. And I think it's partially because we didn't have storms in 2025, thank goodness. But we've also had new laws in place, fewer lawsuits. Whether you live in Florida or you live outside of Florida, you must shop insurance quotes. Don't just stick with the same one, because the lesson here is that there's probably going to be opportunities to get your insurance quotes down. Now let's zoom out again and actually talk about what really influences the housing market prices. Here's what essentially conservatives and progressives agree on, and that is America just doesn't have enough supply of homes on a national basis. Again, this could vary depending on where you live across the United States. But what we know is on a national basis, we have underbuilt for many years. And it's basically because zoning has gotten tighter, permits have gotten much slower, projects are taking longer to actually get jump started. So you're probably going to hear much more talk in 2026 when it comes to increasing supply on the market, zoning reforms, faster approvals, maybe giving builders more incentives to build, because it comes down to pure math, right? I mean, if there's more people versus homes on the market, then prices are going to go up. But if there's more homes in the market and less people, then prices are going to come down. That's just purely what supply and demand is all about. But here's also what you have to understand. If a reform comes into play that really looks to induce volume, increasing volume, it's not going to happen overnight, right? It's going to take years for supply to kind of ramp up. Supply is going to grow slowly. Let's actually see what most credible forecasters that are in this business of forecasting are actually seeing for 2026 when it comes to U.S. housing price growth. And looking at this chart here is that most forecasters are predicting the prices are going to increase, but not by much, maybe 1 to 2% on average. And so the way I look at it for 2026, just looking at these predictions, and if everything holds true right now, unless we have something terrible happening in the macro environment, economics, I just don't see 2026 being the year where the housing market on a national basis is going to crash. But again, always check prices on a local level. But just understanding what's happening on a national basis should give you a little bit more confidence in terms of taking your time and really making the best decision for you. Most important is this: use the national housing market data as a reference point, but always make the real decisions based on your zip code or maybe even neighborhood that you're looking to sell or purchase in. The national data essentially tells you which direction the economy is going to. Is money getting cheaper? Is it getting more expensive? Where is demand picking up? Where is it not picking up? But the micro local information is going to help you understand whether you have leverage as a buyer or a seller. And that's how people who are going to be winning in 2026, if they're in the real estate market, are going to be making the best decision for themselves. I'm Katrin.pfitzenreiter, real estate agent in Sarasota, Florida. Thank you so much for watching today and stopping in. I wish you all a great day.